What's going on, everyone? My name is Nicholas Merton here at Data Dash, and today is November 20th of 2019. Well, folks, I hope you all are having a fantastic day wherever you are. And in today's video, we've got a wide range of topics to discuss. At first, we're going to take a look at crypto markets, and I'm also going to showcase a sneak peek at the indicator that we're building that aggregates our three favorite ones on the market. And outside of that as well, we're going to be taking a look through traditional markets as well, through a lot of major key data sets that are really important. Outside of that, though, as well, guys, we've got a sponsored review of Ember Fund, which is one of the cooler cryptocurrency wallets out there that lets you invest like a hedge fund. So we'll get into that in just a bit. I recommend you stick around for that. Let's go ahead and take a look across the board on the market. So across the board, most cryptocurrencies here ticking to the upside with a few players slightly to the downside here. Again, seeing a lot of different plays across the board here, right? Going above Bitcoin. Bitcoin right now is up around 0.6%. And we're seeing the broader cryptocurrency market tick a little bit higher after the kind of stark sell-off we saw the other day. So again, altcoins gaining back a little bit of that dominance, taking back some of the gains that Bitcoin had. Really, at the end of the day, during the decline, Bitcoin didn't really gain much in the first place, so it's been relatively neutral over the last few days. And we can see here one of the places that's been doing well is Synthetics Network. This is one of the many DeFi projects out there. Augur as well, getting some steam back, up 16%. Engine as well, another one of our top 10 picks for the year, and plays like OX. And also Chainlink down here. So doing pretty good, not too bad. Now, in the sense of actual changes for the market, guys, I'm not going to spend too much time talking in regards to market cap and overall market movements. We're up about $2 billion, 1% across the board. Nothing too severe. And when it comes to dominance, we'll take a look at that real quick. As I mentioned, we can see some of those gains fading on the recent daily candle. But again, nothing severe here, right? I would say that if anything, the thing I'm watching for is if we continue to tick higher and if we get weighed down by the general kind of line of resistance from the previous lows here, right? If we can actually get above here, have a close to some degree, right, below these previous kind of lowering lows here, or so excuse me, lowering highs on dominance. I guess I haven't had my coffee yet. Then in that case, I'd be concerned, right? You could draw some general trend lines here. I know it's going to be very subjective, right? If we can get above here, for example, some of the more significant highs here, that would be something that I would be interested in seeing for a potential trend shift. But to go ahead, as you guys probably have already seen it on the chart here, this is our SMS buy-sell strategy, the squeeze momentum indicator, the MACD, and the stochastic RSI. And it's adjusting in with our 5-point strategy. Now, before I dive into it and explain how to use the indicator, we've still got some kinks to work out. And I want to go ahead and give a big shout out to Sandeep. This is one of our community members who's not only been a longtime viewer of the channel, but has been a subscriber to the newsletter and really took on to this strategy. I mean, he's worked in financial markets for a long time and has come together and really helped in building this indicator through the Pine editor on TradingView. And the really cool thing about it is once we get it all finalized, we're going to give it out to the community, guys. You guys will be able to use it and cut down on all the clutter of those three indicators into one if you'd like to use them in the strategy and the way that we use them, right? So for those of you who may know, we look for 3 points or above to be bullish on something. That's generally how we actually go about using the indicator. We have a point structure based on those three indicators that we use. And I'll do a whole video talking about how to use this and stuff. But you can see here, when we're down here, and below, anywhere below 3 in this case, it's usually signifying that there's a trend shift or there's weakness on the uptrend here, right? And it's usually when it comes back up here to 3 points, right? It comes to this blue line here or above, that's when we can get optimistic. So I'll go ahead and give a good example here, right? There's still some inconsistencies, so it's not 100% built to where I would confidently use this alone to make trades or anything. Then again, I wouldn't even do that in the first place when it comes to markets, right? I do want to look for good support and resistance. There's other ways I analyze markets, as I've talked about in my macro trader video. But you can see here how before any kind of severe move here from the bottom on Bitcoin, during this bottoming process, our indicator was flashing for multiple weeks here that the bottom was coming in for crypto and that we were going to enter into an uptrend, and also started to give us some early warning signs here as we started to get towards the upward region, right? We can see here as well, we crossed here to 3 points, right here. So in this second red candle up here, we still have the majority of the gains here for Bitcoin coming in as we entered into the downtrend, right? So again, I would say this is probably more useful on some of the more mainstream markets like gold, right? Gold was giving us a good sign here when we had the cross. Again, got to ride the uptrend. Had a slight fade here. Again, there's some slight inefficiencies we're going to work out to make it more consistent, but also generally gave us the top up here on the second week to show us that the uptrend was likely over. So again, we're gonna go ahead and work on this. The whole objective here is to make sure we have less of these kind of minute fluctuations, and it actually has a lot to do with how we score the stochastic RSI. That's probably the biggest variable that we need to work out. But it's been a lot of fun. I mean, honestly, I have to give the credit to Sandeep on this, but it's been fun. We did a whole hour-long call the other night, just kind of talking about how we want to actually score the indicator. It's been very fascinating and a very fun time, to say the least, and I'm excited to talk more about it with him, and also with you guys as well once we get it ready. So in the sense of news for crypto, there really isn't much. I'm just, again, as always, guys, I'm very blunt with you guys. I'm not going to try to waste your time. In the sense of cryptocurrency news, there has been an individual who works with Proof of Capital. This is one of the big crypto funds out there, coming out and stating that a China digital currency launch will definitely begin in about 6 to 12 months. Okay, now I'm going to be blunt right off the bat. This is just an opinion piece, right? And I don't want you guys to feel there's some guarantee of this. And also, the real question we have at the end of the day is, what is this digital currency going to look like? I have no doubt maybe China is around the corner of launching something like this, but we still don't know exactly what it's going to be like and if it's going to be a fully complete product that people can use. And will it differ that much from the digital currency that they already have in circulation in China through, through Alipay, right? All the simple systems that they already use, making payments through WeChat, right? So I don't really get how this is going to differ. If it's through a centralized database, most of the money in China is already digital. It's already traceable, right? And you also have the important separation between something that I've learned a little bit more about really just as of recent, but I've known a little bit about over the years and stuff, which is basically the separation of international Chinese yuan in this case and domestic Chinese yuan in this case, right? So the international can be used for international business and trade and things of that sort. But yeah, I just really don't know here. Sorry to kind of ramble on there. I don't get right now why the investor in this case is confident. Right? They don't really explain throughout the article, it's a very short one, why Edith Chung has this confidence. And along with that as well, she really just kind of emphasizes that the U.S. needs to hurry up. It's like, well, I agree with this. We need to, either central banks in this case. We've seen so much talk recently from regulators, from congressmen who are saying that stablecoins are securities, to the Fed talking about a run on the money kind of opportunity where basically people are running to claim their stablecoins for the physical cash, and there's no cash in the vault because of players maybe like Tether. Well, either the central bank needs to issue its own stable coins and take its monetary authority and actually start engaging in this space, or people are going to do it elsewhere. And the same goes for other international governments, right? So again, I just don't see really right now. I see the need for it, but I don't see any confident signs that China is actually going to deliver this in 6 to 12 months. Maybe they expedite something and get something out there. I don't know. I can't confidently claim anything. Now, on a positive reminder, if you were to buy Bitcoin on the vast majority of its history, you're up on your money today. It's not financial advice. It's just facts. All right, I think that's a new t-shirt that I'm going to make. We still have to get to merchandise on the channel and stuff, guys, but 90% of the time, that you bought Bitcoin, you're actually not likely, you are up on your money. So I love how they added this on the indicator. I think they did this not too long ago, where it actually shows the actual percentage of days here. 9/10 of Bitcoin history is where you'd either be neutral on your money or up. It's not bad, especially in a market that has 80% corrections at the end of each of its cycles. And not to mention those days of profitability can be quite nice if you bought anywhere, before 2017, or even back here in 2018, 2019. Outside of that as well, let's go ahead and take a look at traditional markets. So the sector sum indicator is flashing some warning signs, or at least from what it's told us throughout history. The sector sum indicator is a summary. It basically sums about 45 different industries, and basically goes about trying to measure whether or not these industries overall are overbought. The more industries in this case that are starting to enter into overbought territory and showcase a risk of downside return will be added to the indicator here, right? So there's obviously a chance for this to go all the way down to negative 45 and positive 45, right? So we can see here on the indicator that anytime usually we're above 30 points here, right, we usually never get all 45. Not all indicators are usually rallying to all-time highs or stepping up into overbought territory. We can see that usually at 30 points, this is where we get fearful, right? This was the drop here in January to February. So we went all the way from 30 down here to below negative 30. And we can also see here as well in 2019 when there was at the beginning of the year throughout December, there was peak fear and then peak optimism as we did a complete reversal, similar to what we did over here, but in the opposite format, right? So now we're getting to a point here where we're close to 30 points again on the indicator, showing that the vast majority of industries are at a relatively high point. They're relatively overbought, broadly speaking, right? And this has been, bear in mind, I think actually there was an article just the other day that I was reading. It was actually, just like over the last 24 hours, that the tech sector's had its best year since, I think, 2009, if I remember correctly. So we're talking about mass movements in equity markets. Some of the tech stocks, like Apple, have been chugging along, doing great, already at past $1 trillion in valuation, adding tens of billions of dollars in market cap each and every time it ticks up 1 or 2%, right? That's the thing to kind of keep in mind here. The market's a scale. It's much more difficult for these big tech companies to double their valuation, so it's going to take a lot more stock buybacks. It's going to take a lot more cheap liquidity. So let's go ahead and take a look at some charts here from the Daily Shop Brief. They get some good photos from the Wall Street Journal. So we can see here, the first one here is the S&P 500 percentage of range, the 10-day moving average. Long story short, pretty good measure of volatility here. And we can see here that there is little to no volatility in the market. Taking a look here, we can see that we're back down to levels we saw back in April and even further past where we were in July of 2019. To really get the real perspective here, though, it's what we see back in 2018. This similar situation where we hovered within this channel for a good amount of time without any serious breaks outside of that channel around the 0.5 range here in the indicator. And then again, that's when we had this stock buyback blackout period, and we also had as well some general topping out in equity markets that led to a really stark sell-off here where volatility on this index shot up to 3 points, right? So a big difference in a very short period of time going into the end of the year 2018. Could we see a repeat here, right? Could we see a slightly delayed repeat here in November and December? Could we start seeing a little bit more volatility in equities? Who knows? But I will say we don't have that much further to go from at least what history is telling us in this case. Might be fortunate enough to come down here below the channel. Who knows? I don't see it declining at the kind of rate that we need at the moment in order to do something like that. It seems like we had a much sharper one, not to mention coming from an environment that just generally had lower volatility. But there's just been more uncertainty over the last few years. Either way, thought it was an interesting indicator to toss to you guys. Outside of that as well, record high uncertainty in China. Well, it doesn't seem like it's just the skeptics, here in the United States and abroad that have a few fears about how China is running its economy. We now have the news-based index, which is basically measuring mainland China news outlets discussing uncertainties around the economy, and also the EIU reports using the word uncertainty. So you have a correlation of these indicators. It's always interesting to track indicators of use of certain terms in the news. And we can see here that both are starting to spike up more than they ever have over the last few decades. So again, I think very challenging and interesting times for China. Not saying that China is doomed or anything like that forever, but I think it's getting to a point where we might be very well on the verge of a recession. This is why China has had to en masse. I wish I would have brought up the article here. I think they're planning this month to have yet again another all-time high and new credit injection on the local government level. So I mean, it's incredible just how much they're doing right now to keep the machine going. And this is all coming at a time where the Chinese yuan already got devalued to where the dollar is at a 7-to-1 ratio for the yuan. So basically, you'll buy seven Chinese yuan or more with one single US dollar, right? And this was something that many people talked about for 2 years and were called crazy, that we could see the currency get to that kind of ratio. And many people doubted it, but it happened. And it's continuing to happen, and it's getting worse and worse, right? I mean, with this kind of credit creation, it's going to be a big issue. But that's what China has to do in order to keep the machine going, right? To keep equities pumping, right? Now, another thing as well, growth differentials are set to swing in favor of the rest of the world over the United States. So this is, again, an index showing here generally how emerging markets, the growth differential here between the United States and the rest of the world has it looking as if it's going to increase in this case, right? So in this case, we're expecting that over the next few months, this economic model, at least using the previous data, and this is by Haver Analytics, they're basically taking a look at data from IMF, Morgan Stanley, and the whole combination here is that they're expecting a forecast that emerging markets in this case are going to outpace the growth factor here compared to the United States on average. So, right, as we've seen through 2017, 2019, if I'm reading the indicator right, this would make sense. It would be that over the last few months, the growth differential for emerging markets has declined. And there's been a mixture of currency crises, there's been a dollar squeeze. So the U.S. has had some strength over the last few years as money has flowed back as we've had a repatriation of funds due to the new tax bill. But it looks like some of those effects are going to wave off and a lot of capital is going to start going back overseas. Or the U.S. just isn't going to grow at the rate that it was before, right? Maybe we're running off the highs of the tax cut. Now, I want to talk about something very interesting. The countries most in debt to China, something that's not talked about a lot. Look at all of these nations throughout Africa. Take a look at these guys. The ones that are over 25% in debt to China. Djibouti, Niger, Republic of Congo, Laos, Cambodia. So you have a lot of different countries here, right? And the major thing is you notice that a lot of the countries that are really, hit hard by China here in debt are throughout Africa or a lot of developing regions like South America. There's a reason for this. The reason being is because China is doing exactly what the United States did to a lot of developing and emerging economies back in the 60s and 70s, but in a different way, just a different format. And if you guys want to know what I'm talking about, you guys should definitely check out the book, The New Confessions of an Economic Hitman. It's a great book. Basically talks about how you can use debt as a tool to control nations. And out of all areas of the world, let's say, for example, you could get something out of putting a country in debt in order to negotiate or hold some leverage. Well, what would you care about throughout most of the nations in Africa if you were China? Let's think about it for a second. Very simple principle. What does China need when it has well over a billion individuals and growing towards 2 billion individuals in its country? It's resources, it's commodities, it's energy. That's exactly why China is doing exactly what the United States did when it used debt as leverage in this case from its private lenders initially and then going to the IMF in order to negotiate structural readjustments. And that means deregulate, detax, open up your massive resources of commodities to our producers and let all of our massive, well-developed companies in the West go in and basically take advantage of the situation, right? That's basically what's happening. On a different scale here. The way that China is actually doing it, to be fair, seems a little bit better in the sense that they've been building infrastructure. So maybe this time the infrastructure will actually be a little bit better than the ones that we did with all the engineering companies. Long story short, guys, I don't probably have all the time to explain it. It would be a multi-step process. Engineering companies would come to these developing countries, propose great new projects that would be awesome and promised enormous amounts of economic growth. They add statistical models, things of that sort. The country agrees to build it. They take out a loan from private lenders in the West. That money never sees the daylight in the country. In fact, it goes to the contractor who's building these engineering-based projects, these architectural projects. And then after that, all the money's staying there. The country never has the economic growth that they expect, and therefore they can't pay down the debt. So in that case, either the IMF steps in and they basically say, look, you can either allow us to refinance your loan in this case at a lower interest rate, or we can basically cut you off from the world in this case due to your low credit rating and your low ability to pay back debt, and we're going to cut you off from foreign investment. So if you play by the IMF's rule, you have to go through structural readjustments. And that's, again, all those points I mentioned: deregulation, detaxation, everything you could think about that would keep these countries from developing further. That's basically what they would do. So again, maybe it wasn't intentional, but that's what would happen back in the 70s and 80s, and it has kept so many countries back. China's doing it in another way, though. Very fascinating factor that a lot of people don't know about. Anyways, the quality of bonds since 2008. Take a look at the spike here in single A and BAA bonds in this case, right? AAA bonds, almost nearly non-existent. No growth whatsoever, actually setting a new low here in October for the last few decades. But we can see that other forms of bonds here, right, for corporate bond issuance, continuing to grow, right? We're seeing a higher amount of corporate debt. We're seeing a mass amount of this debt being used to, again, supplement costs so that they can continue to finance the cash on their balance sheet towards stock buybacks, ridiculous expenditures that companies used to not focus on. Remember when companies used to invest in the real world economy? Remember when they weren't laying off thousands of people across the board, where we used to actually have a manufacturing sector in the United States? I remember when the auto manufacturers of our country used to actually invest in factories, invest in its employees, and actually pay pretty decent wages, when nowadays they've decided to opt in for laying off thousands of workers, deciding to move plants overseas, and reinvest some of those savings from pinching pennies into their own stock. It's just a bit upsetting, guys. Like, that's what this is. Like, this is the only reason. Like, corporations are not taking extra debt to invest in the real world economy. I mean, where are the billions of dollars of this corporate bond issuance? I don't see it. I don't see it anywhere. It's not helping Main Street whatsoever, and that's not a anti-capitalist view or anything like that, guys. I'm a huge free market guy. Real free markets, if this was actual capital being taken out of credit in order to stimulate business, it'd be great. We could see it, but it's not. It's to supplement the cost of stock buybacks. Plain and simple. All right. Anyways, I've rambled on enough for today, guys. That's going to be it for the daily update portion of this video. So let's go ahead and dive into our long-awaited review of the Ember Fund wallet. Alrighty, everyone, so let's go ahead and spend some time to focus in on today's sponsor, and it is no other than Ember Fund. Now, for those of you who are active viewers of the channel, you've possibly heard me mention Ember Fund before, and for those of you who are hearing about it for the first time, to put it simple, Ember Fund is a cryptocurrency wallet that allows you to invest like a hedge fund. Now, it's not only really great in the sense that its user experience is really simple and streamlined compared to a lot of wallets that I've seen, but the liberating fact that it makes it so easy to diversify into a variety of assets and own the management of your keys is really exciting. So we're going to be talking about that in today's video, and we're also going to be taking a look at the actual application itself. But the key points here again are as follows. You have the asset management in this case of a variety of different cryptocurrencies, a lot of the mainstream cryptos as well as some altcoins that a lot of people are interested in, as well as the fact that it's non-custodial, so you own your own keys. And it utilizes a lot of interesting technology to get you some of the best routed orders to get the best prices on these assets, which I think is very, very important in that process. All right, guys, so let's go ahead and start to take a look at the actual app on the mobile device. Alrighty, everyone, so let's go ahead and spend some time to dive directly into the app real time on my phone. As we can see here from the get-go, the user experience is really clean, as I hinted to earlier. It's really appreciated in a crypto wallet to have a clean experience, and right from the get-go, you can see your portfolio, your current holdings, and in this case, you can already see that I've tested out the application. Now, when you open this for the first time, it's going to have no portfolio, obviously, and it's going to have a list of the cryptocurrencies that they offer, and they even offer TrueUSD if you want to kind of hedge outside of cryptocurrency volatility for the time being, or maybe if you believe there's a pullback. But we can see here that I've already tested it out right now. I've got about $300 worth of crypto that I bought, and it's what I call the safe haven portfolio. It's one that I just created on the application, and it's a 50-50 split between Litecoin and Bitcoin. So kind of a safe haven portfolio against hedging against other traditional equities and markets, as we talk about on the channel. So I want to go ahead and make a few things clear before we dive into the cool functionality, which is being able to build your own custom portfolio, investing in a variety of indexes, and being able to diversify amongst a lot of cryptos. The first thing to take into mind is that if this interests you guys, make sure to download the app. It's very simple to register, and make sure you got enough crypto, or Bitcoin in this case, for the minimum deposit for the fund that you want to invest in. It's a very key limitation to take into mind when you're using Ember Fund, and that's to make sure you've got the appropriate amount of money, because there is minimum deposits that you need in order to invest in some of these funds. So I've got enough in here in the case to buy the one that I've got that I currently hold, but I'll walk you guys through what it's going to look like in this case in order to go about buying a fund. So for example, I've got one here. It's called the Marius 5S tier fund, and this is based off an individual who's quite popular on Quora, which is a question and answer site in relation to the topic of cryptocurrencies. He's got 6 million views monthly in the case of the questions that he answers. So he does a big part in answering questions for the community. And he's got a portfolio here that's 45% Bitcoin, as well as an exposure of 55% to 2 different altcoins between Dent and one of my favorites, Basic Attention Token. Now we can see here that we not only see his current holdings in a very easy graphic, but we can also see the performance of his fund over different periods of time. We also have as well the DataDash Index Fund, and this one is overtly exposed to peer-to-peer digital currencies. You guys know that I'm almost insane sometimes with how much I push the use case of peer-to-peer cash and money for cryptocurrencies. I do believe it's the ultimate use case. So in this, you can see exposure to Bitcoin and Ethereum with all that it's doing in the DeFi movement, as well as Litecoin and Dash. Very clean, easy to use. Now, let's say, for example, you wanted to invest in this fund. You simply click the button. We would check on what the minimal deposit is. Now, I do not have enough in my wallet in order to make this deposit, but we can see here it's about $889. The other ones are a little bit cheaper, usually around $300 to $400, so much more reasonable. But you can just simply click Make Deposit, go through with it, and in a matter of seconds, they start actually going through. They detect what portfolio you want, and they start scavenging out the best rates on the market in order to give you that portfolio. And pretty minimal fees in the sense of being able to purchase that crypto, and also there are fees as well when you're rebalancing your portfolio. So like a normal hedge fund, there's management fees in this case, but in this case it's only if you want to rebalance. In this case, if you want it to be active, and let's say for example the DataDash fund might add Basic Attention Token or Chainlink if that becomes an asset on Ember fund. In that case, you'd want to make sure that you'd be able to get exposure to those assets if you, again, wanted to take that extra risk. So all in all, guys, the experience is clean. It's liberating in the sense that it's giving you the ability to invest like a hedge fund. I love it for that reason. And it shows you the power when you're your own custodian of your own crypto, just how easy it is. I didn't have to do any excessive KYC. I just simply registered an account pretty much in less than a minute. So it was really, really nice. So again, they provide all kinds of stuff for you to manage your own keys very simply, to have a clean user experience, and to get a wide range of crypto exposure. So I got to say, Ember Fund is definitely leading up there. Definitely give it a try. Check it out. It's free to download an account, guys, and check it out for yourself. So anyways, thanks to Ember Fund for sponsoring this video. And guys, I hope you all are having a great day wherever you are, and I'll see you all in the next one. Stay tuned. And real quickly, everyone, I just wanted to make one last remark because I like the startup so much. Ember Fund is actually doing an equity crowd raise on Republic.co. And for those of you out there who know that A, I love startups, and also I love that we can finally, as retail investors, invest in these early stage companies, Ember Fund is one of those companies you're able to invest in on the Republic platform. So it doesn't matter who you are, if you're just investing with a few $100, or if you wanted to put thousands of dollars in, you're welcome to. And the nice thing is it's real equity. It's a real company, a real product, generating real revenue. So you can already see they've been doing very well. They have already 635 investors. I'm not saying you guys should invest in it. I'm just saying if you're interested, you can check out the link down below. We'll leave it down there for you guys. But I love what Republic's doing, and I also love what Alex and the rest of the team are doing over at Ember Fund. So definitely check them out. Check out the campaign and read up on some details in relation to the company if you want to do some more research. Anyways, guys, that's going to finally be it for the video. Thank you all so much for watching, and I hope you all have a wonderful rest of your day. Take care, everyone.